Hi everybody, welcome back to Ox Talks. It is Wednesday, November the 8th, 2023. If you are enjoying these videos, I would really appreciate you subscribing to the channel, letting your family and friends know about the channel. We're starting to develop quite a nice little community here. I really appreciate the comments. I appreciate you engaging with each other in the comments. I do read them and try to respond to them. Please also hit the thumbs up button and continue spreading the word that we're trying to get across to family and friends about the dire nature of the economy and events, not only domestically but worldwide, that are unfolding, that are going to have a financial impact on all of us. Well, today I thought I would have the day squared away real well. I had a court hearing this morning, attended that via a Zoom platform in a local department, and it turned out the hearing was at 8:45 this morning, and the judge had a full docket. He did not call the case until about 11:20. So I spent nearly 3 hours sitting on a Zoom call, killed the entire morning, caused everything else to shift back during the day. A little frustrating. I know that you all go through that as well on a daily basis when you've got your mind set up on how much you're going to accomplish in a given day, and it gets all screwed up. But you know what? We got to roll with it. Exercise patience, and that's part of being busy and running a business. This judge today was not real happy with the local lawyers who didn't attend the hearings in person in his courtroom. I'm not before him very often, and I'll tell you, as I think I mentioned on the show before, or one of the early videos, about the fact that during the pandemic, things shifted away from putting on the suit and tie and going into court, even for trials. Now, of course, for trial work, we're back having to be obviously in person. But most departments give everybody the option to appear either via Zoom or by phone or in person. And I'll tell you, the old days of getting up 2 hours early, putting on a suit and tie, getting in the car, going down to the courthouse, dealing with parking, having to deal with, talking with a whole bunch of other lawyers in the courthouse that and I'll tell you, it sure is nice to be able to sit in the office and conduct the business through the Zoom platform. Usually it's much more efficient on mornings like this where I'm caught on the phone for 3 hours. Not necessarily so much, but anyway, just ranting a bit there. Thought I'd pass that along to you relative to one reason why I'm getting a video uploaded a little bit late today. But I do have a lot I wanted to discuss with you. I think I mentioned yesterday in closing that I was unable to get to some stories that I had uncovered relative to the air freight industry. And of course, I found a couple other articles today that tie into the shipping industry and the trucking industry, which, this stuff, it is global, and it all sifts down eventually to having an impact on our domestic finances here in the United States. But first, I wanted to address an article I saw on Hedge today. It says, world's top tractor maker slashes outlook, trims jobs in response to slowing sales. And it says, C&H Industrial, a global leader in farm equipment with top brands such as Case, New Holland, and Steyr, saw its stock prices tumble on Tuesday, the largest intraday drop since June of 2020. The decline followed the company's decision to cut its revenue outlook for 2023, attributing the downward revision to a global deceleration of agricultural machinery demand. Also, the company announced an immediate restructuring program that will result in a cut of 5% of its salaried workforce. It says sales for the third quarter fell 1% to $5.33 billion, below Bloomberg's estimate of $5.8 billion. This says the decline in sales is primarily due to falling tractor demand across South America and Europe. As a result of the slowdown, the company announced an immediate restructuring program targeting a 5% reduction in salary workforce cost and will be coupled with a comprehensive right-sizing of the company's cost structure to be implemented early next year. And it says shares in the U.S. on that news fell 12%. The news follows Caterpillar's earnings 7 days ago when it warned about a more cautious fourth quarter and said order backlogs had fallen. A softening in worldwide tractor sales could serve as a harbinger for a global slowdown, signaling growing economic turbulence due to the Federal Reserve's aggressive monetary tightening. Shifting to the theme of freight shipping, or whether it's by sea, by air, by land with trucking, those industries are all being substantially impacted right now. There was an article that I saw on Business Insider a couple days ago. It says air freight demand has cooled so much that FedEx is telling its pilots to fly for American Airlines instead. And this article says FedEx's message to its pilots comes after a year of cost-cutting measures, including job cuts and closing of offices. That's amid global air cargo volumes falling over 8% year on year since the first quarter of 2022, while cargo rates have slumped 40% to 50% for most of this year compared to 2022, according to Freight Waves. The decline in air cargo demand is due to a plunge in ocean freight rates and the resumption of travel post-pandemic, which allows passenger flights to carry cargo alongside travelers. And listen to this. It says FedEx is encouraging pilots at its cargo airline to take jobs at regional passenger carrier airlines because there isn't enough shipping demand to fill everyone's flying schedules. It's the latest step over the last 12 months to align FedEx's air network with a sharp decline in package volumes and to improve efficiency as the parcel sector settles to a lower post-pandemic baseline that could last for years, it says. It says the FedEx memo underscores how financially difficult the market has become for freighter operators in the last 18 months, which with volumes and rates hovering at or low 2019 levels. Global air cargo volumes are down more than 8%, and rates were 40 to 50% lower for most of the year versus 2022. That restated something that was earlier in the article. So that's FedEx. I listened to this article, which came out, I believe, the same day. I think it was yesterday, from Yahoo Finance. It says UPS reduces pilot headcount by nearly 200 with buyouts. And this says nearly 200 senior pilots at UPS have accepted the company's voluntary severance package, and regional passenger airline PSA Airlines is trying to recruit them to close a crew shortage. The headcount reduction at UPS Airlines is much more limited than one envisioned at rival FedEx Express, where management has acknowledged it has more than 700 excess pilots, and on Friday urged flight crews to quit for the same type of offer at PSA Airlines, an American Airlines subsidiary that operates in the eastern half of the United States. It says UPS in late August offered early retirement to veteran pilots as part of an effort to reduce costs in the face of shrinking parcel volumes. And it's looking to eliminate 167 positions, it says. UPS is adjusting its network and flight capacity in line with deteriorating market conditions. And another article that came out, I believe it was yesterday or today, yesterday on CNBC. This talks about overall shipping. It says the global freight recession will continue into 2024, CNBC Supply Chain Survey says. It says the global shipping industry has been mired in a freight recession this year, and the challenging economic conditions will continue into 2024, according to a new CNBC Supply Chain Survey. High inventories and a pullback in consumer spending are reasons behind the bearish outlook. So look, I mean, if the consumers are broke, the consumers, again, have tapped their credit lines, their credit cards, they're having a difficult time making ends meet. We discussed yesterday that they're pulling money out of their emergency loans, out of their 401k plans, just to pay their basic living expenses. You know, that means that consumers are not buying the stuff off the shelves. Retailers are not therefore placing orders as they once did. The inventory they were working down is starting to work down, and there's not enough demand for worldwide shipping, either by air, by sea, or by truck. So this is big. This is big news, and I didn't see one projection that indicated it was going to pick up anytime next year. So the CNBC Supply Chain Survey was conducted October 21st through October 31st among logistics executives who manage freight manufacturing orders and transportation, including those at C&H Robinson, Seco Logistics, DHL Global Forwarding Americas, Quaney and Nagel, OL USA, and its logistics. It says these companies have insight into the orders shippers place into manufacturing companies around the world because they pick up the product from the ports as well as distribute the products from warehouses to retailers. It says this part of the trade pipe gives investors a 3 to 4 month advance insight into retail consumer expectations based upon the number of orders placed and the amount of product they have truckers move from the warehouses to the stores. It also provides a read on freight rates and what kind of freight volumes will be moved by truck and by rail, two key revenue drivers for companies in the shipping sector. And it says in closing, we're talking about now shifting over to trucking. It says, we expect retail peak season for trucking to be sluggish, said Noah Hoffman, Vice President for C&H Robinson, North America Service Transportation. The freight recession has been hard for the industry, and those companies that were not diversified enough to withstand downturns, leading companies like Jeff Bezos' backed trucking startup Convoy to shut down. According to Tank Transport, rising fuel costs and falling freight rates caused a total of 31,278 trucking companies to either close or shift services to larger fleets. So we see a contraction in the global shipping industry. We see a contraction of many larger companies. We discussed on the show a few days ago, the layoffs that are already starting and are going to, in my opinion, start coming in waves into the coming year. You're seeing a shrinking of many industries. And it's because this is a consumer-driven economy. Without the consumer spending, swiping their credit cards, there is no economy. And, you know, how the stock market continues to whistle past the graveyard here and ignore the reality is still baffles me. I understand the underlying reasons why the market is still ticking up and what that means for expectations with the Fed. But the point is you have one reality in the markets, another reality, at home in these local communities, Main Street versus Wall Street. The divergence is growing larger. So with that being said, I'll leave it there for the economic, the financial discussion today. Please make sure all of you get your workout in today. I'm going to be going and doing my 1 hour of training here in about an hour and a half after I upload the video. Get your half an hour of steps in. Please do some push-ups and sit-ups. Keeping muscle mass, strength training is very important to ward off a whole host of health issues and difficulties. Again, I'm not a doctor. I'm not giving medical advice, but research yourself. There's a whole lot of data out there to support that we all should be exercising and staying healthy. I hope that you got something from this video today and it wasn't too long and rambling. I look forward to seeing all of you tomorrow. Bye.